We are recording.
All right, welcome to the micro training on the legal frontiers of foundation investments. This is a favorite subject of mine lately because we're always trying to think of like, what are the resources that we can tap for solving all kinds of social problems? And, there can be so much, so many limitations in the access to resources that we have from just like raising grassroots donations. And when there's so many crises going on, the big question is like, what about this trillion or so dollars that's sitting here in these foundation bank accounts as endowments or other kind of assets? How could we access that, not just to put out the fires of the world, but to build the solutions that can replace the destructive system, as in like create actual community wealth, which I think is a particularly appropriate place for foundations to be putting their assets, as in like investing in things that are stable, and build assets in our communities. So I feel like a lot has changed as far as the legal boundaries of foundation investments in the last 10 or 15 years. And I don't think that lawyers and their foundations have been keeping up with those legal developments. And I think talking about them is a really important thing right now so that we can basically empower foundations to push the boundaries where they can, or at least explore the frontiers, as I like to call it. So I created this little structure for explaining the boundaries in which I understand foundations to be operating as far as how they can invest their money. So on one side, they are governed by the prudent investor rule. Like they need to manage their assets as an ordinarily prudent person would. And this is governed not just by 501c3 law, but state laws that govern the management of charitable assets, like the Uniform Act here. And so on the other side, though, they're able to grant, lend, or invest money if the primary purpose is to accomplish their charitable or tax-exempt purpose. And a significant thing to note here is that if they're doing it for charitable purposes, then production of income cannot be a significant purpose. So, and one thing to note is that there's this, a lot of people know about this 95%, 5% rule. There is a rule with private foundations, not public charities, but at least private foundations, that they need to distribute at least 5% of their assets every year. And that doesn't just mean making grants. It can include making program-related investments. But the really important thing to note is that 5% is not a limit. It's a minimum. And in fact, depending on the nature of the foundation's assets, they could be moving a lot of that over to the charitable side. Some foundations are free, could have the latitude to move all of it over to the charitable side, which if you think about it, makes sense because charities exist for charitable purposes. Why wouldn't they want to just move it all over there? Hang on one quick second. Turn my phone off. Okay. So within these boundaries, an interesting thing to note is there's a strange gap in the middle. There's not like a continuum of nice. It's like anytime our legal system needs to draw a line between one thing and another thing, it also creates a strange gap around that line to kind of justify the fact that that line exists. And we're never really sure like how close can we get to it? Where does that line actually live? But the IRS has given us, and other laws have given us some hints about ways that we could venture out into that gap safely, sort of. And one of them is this space called mission investing. This is what people tend to refer to as mission investing, is walking out on this little plank to consider the charitable purposes, because both the IRS and the Uniform Act, I believe, say that you can consider an investment's relationship to a foundation's charitable purpose. But note here that it still has to be a prudent investment, which generally means like retaining the assets and growing them. So you can consider it as long as, it's still going to be a fairly stable investment. So that's one rickety little plank they can walk out onto. Another is that on the charitable side, the rule is production of income can't be a significant purpose, but that means it can be an insignificant purpose or kind of an incidental result of trying to advance your charitable purposes. So there is kind of like this plank. You're not really supposed to walk out onto it too intentionally, but you can actually produce income from your program-related investments. So it's a weird thing to have this kind of gap in the middle where you can't have these complex thoughts where you hold income generation and purpose equally in your mind. That's not allowed. You can either have, prudent investment be the primary purpose, and just make sure your mission investments don't get too missiony, like don't go overboard there. And your program related investments, you don't want them to get too investment-y. Don't start thinking too much about like, will this earn a profit? Can this, company pay us back with a return? You don't want to go there too much. And then the question is also, well, what happens if you do go too far out into that gap? Like, what are the consequences? Is it going to bite you? And the interesting thing is, it's hard to know. The law right now is really fuzzy. There haven't been cases where, for example, the IRS has determined that, oh, you all made a jeopardizing investment. And so there have been cases that have concluded that an investment decision was inappropriate, but that's usually on the basis that some other bad behavior was present. So usually they tend to decide that the investment decision was reasonable, except for where there was something else going on, like self-dealing. So we don't really even know how far we can walk out in the middle. And so back to the prudent side, one problem that we're facing right now as the stock market crashes is like, what is prudent anymore? And one thing that's helpful to know about this pillar of the Prudent Investor Act is it's not really a pillar. I call it, it's not a legal pillar, it's legal Play-Doh, meaning we get to reshape it over time with reference to our current economic circumstances. And it's been reshaped a number of times, because prudent used to mean investing in bonds. That was considered to be a very stable thing to do with your assets. But then there is a bond market, and it became unstable in the 70s. And so there was an opportunity to reshape, oh, what is prudent? And then came this modern portfolio theory being so widely adopted as, yes, this is the prudent thing to do, is spread your assets over a range of different categories of investments to kind of spread the risk across those. So that's, for a very long time, been considered the thing that's prudent. But here we are right now, where a microorganism can crash the stock market. So how protected is that modern portfolio theory under circumstances like these? And then there's also this other thing that's happened in the last 10 years. This is fascinating to me. Like, what does this mean? Which is that this passive investing has become the new normal. Passive investing refers to when you take your investment and you put it into like a fund, mutual fund, or something that mirrors the S&P 500. Like, you're spreading all of your investments across the entire market. And I call it like modern portfolio theory on steroids. You are like super ultra diversifying, but in doing so, and by the way, Hewlett Foundation just put out a report, or they commissioned a report that talks about how this has grown so rapidly. In some places, it's grown 5-fold in the last 10 years. In the US, it's gone from being a little over 20% of all investments about 10 years ago to now being the majority of investments in the US are now passive funds, these exchange traded funds. This is a big change. And so what does that look like is like all these people who have really diverse portfolios that include inherently volatile investments like fossil fuels and other carbon intensive industries. So there's things all mixed into this portfolio that can just explode at any time or collapse at any time, which puts the entire market at risk. So with everything going on, the rise of passive investing, the sort of demonstration that little things can crash our stock market, I don't know what is prudent anymore, but I do know, I feel pretty certain that if someone said, let's just get our assets out of the market entirely and find something else more tangible to invest in, that's probably not an imprudent thing to do. But what is prudent? That's still a question. And it's a question that's so kind of up in the air right now. Well, for one thing, we're having another webinar next week called The New Prudent. This is on the Law Center's website, or it's part of a project called The Next Egg, which is about channeling retirement savings into local communities. So we're going to have a whole webinar just to talk about this concept of prudence. But since it is such a dicey question right now, what I would suggest to foundations is like, good news. You guys don't have to follow the prudent investor rule for everything. Like, by contrast, pension managers do. But foundations, you have this other space that you could hop over to by moving more or even all of your assets over to the charitable side. And then you can forget this prudence question altogether. Yay! But then, okay, so then now you have to do the whole question of what is charitable. And there's like, charitable is not my favorite word, or I think anybody's favorite word. It tends to connote a kind of a patronizing or paternalistic relationship between the charity and people who are poor or needy, and just like, putting a Band-Aid on those problems. But, charitable is also legal Play-Doh. The definition of it has evolved a lot over time through the IRS interpreting it and reinterpreting it a lot. Usually, for the most part, not by the actual statute changing, it's just the interpretation. So that's why it reshapes in connection to surrounding circumstances. And so with the Law Center, Sustainable Economies Law Center, we have so many clients who are not your grandmother's charity. And we're often in the position of asking a question of, could this actually be a 501c3? Or could, at the very least, could it be funded by a 501c3? So I'll just share a little bit about how I've come to analyze this and explore these frontiers, because I think there's a vast, beautiful frontier out there. And I'll just give a short history of how I've seen the IRS think about these things and reshape its understanding. So here we are, 1967. The IRS, some organization wanted to get tax exemption for protecting land, and the IRS was like, protecting land? What? That's not charitable. Who does that? But it wasn't that long afterwards, 1975, they were like, oh, okay, so, right, land is being destroyed and people don't like that. Society is recognizing that this is a problem. So, all right, we get it. All right, protecting ecologically significant land can be a charitable purpose, with an emphasis on this ecologically significant, which always has cracked me up because it's almost implying that there are these islands of land that are completely unimportant. But yeah. So then after that, there was, agricultural land trusts came along, or other organizations protecting agricultural land, and the IRS denied them tax exemption, saying, well, that's not ecologically significant. Farms are just farms. They're everywhere. What's so significant about that? But meanwhile, Congress and other states passed laws to protect farmland, because there was a widespread recognition farmland was being degraded, diminished, developed, and that society was worried about that, worried about the impact on our civilization. And then because of that, the IRS saw, oh, okay, so everyone does think this is ecologically significant. Fine. Agricultural land trust, you can be tax exempt. And so this is how it's evolved. And sometimes it doesn't even evolve through a direct ruling or new guidance being issued. The only way we know it evolves is that the IRS started giving the stamp of approval of 501c3 tax exemption to agricultural land trusts. So that's how we saw it evolve. Same with legal services. It used to be the IRS would decline tax exemption for charging for legal services because they said, oh, commercial lawyers, for-profit lawyers do that. That's not charitable. But eventually, and this is pretty recent development, the IRS started to understand how huge of a gap there is of like 80 to 90% of people in the US not being able to afford essential legal services. And so they've just started granting tax exemption to organizations that charge reasonable fees for the provision of all kinds of legal services. So share all that to say, this is the trend, is that when we have evidence and recognition of a problem, and that problem is not being solved, or maybe it's even being caused by the existing landscape of solutions, then there is now room to recognize additional solutions as charitable. And this is why I would tell foundations, there is a whole vast frontier out there of new solutions, creative problem solving that's happening that merits being funded using your charitable funds. Because where are we right now? It's not only that we have a lot of problems in society, but there's evidence that a lot of those problems are on a path toward getting worse. Like the problems are deepening. We even had an intern, and I could share this slideshow so you have the links to these fact sheets. We had an intern, gave her an assignment to not only collect statistics about how things are bad, but also evidence that they're getting worse. Because if we can show that a lot of things are on a path toward getting worse, it's like we can't just keep throwing aid, like Band-Aids, on it. We need like an actual game-changing solution that turns things around. And a lot of it you could just trace back to, it's like our dominant economic system is rewarding the extraction of community wealth. And it's like, this is a lot of what's driving the problem. So we should view as a charitable solution anything that creates an alternative to the dominant economic system. And since the dominant system, like the current economic game we play, is about rewarding concentration of wealth and power, then what solutions will we want to support and fund are solutions that spread wealth, spread power, and also root that wealth and power in our communities, which may turn out to be a lot of things that look or smell like cooperatives, which I want to address just really quickly, because cooperatives are about people coming together for their own economic self-determination, and that's always been a strange fit for 501c3. It's like not your typical charity at all. And this is another case where the law forces us to divide our mind in half. Sorry, these are cakes. There's chocolate cake, vanilla cake, but there's this this idea that there are organizations that exist for public benefit purposes. Then there are organizations that exist for people to like benefit themselves, but there's not a really great in between. So again, it's like it's challenging to have complex thoughts and motivations. But what we're seeing, and this is our sweet spot at Sustainable Economies Law Center, is organizations oriented toward public benefit that are also being driven by a lot of community engagement, of communities being motivated to provide for themselves. We also have a lot of cooperatives that are not just benefiting their members, but working on broad movement building and systems change. So it's like they're mixing in the ingredients of the other. And so where does that fit, particularly when we have these awkward rulings by the IRS? And this is one that I don't like looking at it straight on. It's like staring into the sun because it's like really bad precedent, which is to just say that in this case, a group of low-income people who were going to manage housing for themselves, the IRS said, no, that's not charitable. Because, yeah, it could be charitable. They said it could be charitable if the low-income families were managing housing for someone else, or if somebody else was managing housing for them. But basically, you can't join with others to help yourselves and call that a charitable purpose, is what they were saying, which is frustrating to me. But that was 50 years ago, and this is why I'm glad that this is legal Play-Doh and not a legal pillar, is that we can point to a lot of changes and circumstances in the last 50 years that might prompt a different interpretation of situations like that. I mean, we have a Nobel Prize winning economist, Elinor Ostrom, who basically said the best way to sustain common assets in our communities is for the communities who benefit from them to be the ones self-determining what happens to those assets. And she got the Nobel Prize because she also observed these principles around the world for how communities effectively manage assets. And much of what her principles point to is participatory and democratic engagement. So there's that. Oh, and by the way, the cake metaphor is something I use for explaining other things. I was trying to think of if I could come up with a different metaphor or visual, and I was like, maybe something in nature, like what in nature simultaneously helps others while helping itself? And then I realized, oh, everything in nature does that. We're all part of an ecosystem of like, we have an instinct to survive and to provide for, say, our families. And in doing that, we're benefiting those around us. And so this is a very natural thing to do. It's kind of unnatural to think that we need to divide organizations across public benefit and mutual benefit. So this is how I come to the conclusion that like the ruling from 50 years ago, we could very easily come to a different conclusion now because we have a lot of evidence of a housing crisis. We know that the current systems aren't solving it. In fact, the current systems pretty much created this crisis, like systems for managing real estate and housing. Sort of the alienation of people from their land and the commodification of land that results from that. So therefore, we definitely need new solutions. There's mounting evidence, thanks to Elinor Ostrom and new solutions emerging, that self-determination could be one of the best ways to solve that problem, which is why self-determination models can advance charitable purposes. This is my argument. And I think it's a good one. And it doesn't necessarily mean that a worker cooperative or a community-owned solar cooperative is going to get recognition as a 501c3 without there being, I don't know, more layers of clear community benefit. But it does mean to me that a 501c3 can fund these solutions, that if you're a foundation, you don't have to worry about, could this cooperative be a 501c3? You only need to ask the question, would funding this cooperative advance our charitable purposes? So I think definitely foundations have a lot of latitude to make no interest loans, negative interest loans, high risk investments in these cooperatives, because this is really what they need to get off the ground. And just a couple other things to address, like there's this worry, like foundations are worried, like what if our assets get smaller over time? Like, isn't that irresponsible? I'm like, should we worry about that? And I just say, well, probably not as much as we should worry about the widening and incredibly already wide wealth gap between white households and Black households, for example. Like, this is a crisis. Like, we should maybe worry about this first. Similarly, like the fact that 93% of the wealth is already held by the wealthiest 20%, that's probably something we should be worrying about more. Then there's also our deadline for reversing climate change. And so this is less of a legal argument and more of a moral argument I would give to foundations is like, yeah, maybe you've been operating on this theory that the best way that you as a foundation can benefit the future is to preserve your assets until the future. But another theory, given everything we know about what's happening in society right now, is that the best way to benefit the future is to transform things right now. And I think about fish every day because the year that I'm going to retire, roughly, that's when seafood is no longer going to be, potentially in the ocean. Like, this is a completely different time and different playing field that we're operating in. I think really merits foundations using their assets to the best effect right now. So I think I was going to end with a fish, and yeah. Oh, I had one little. Here's our new portfolios of investments for land trusts, which is not, so instead of thinking about this as decreasing the wealth of the foundation or the assets of the community, it's about increasing community wealth and assets. Okay. Oh, look, we had more people join us while I was talking. Hi, friends. Feel free to share your thoughts and questions and feedback. And one other piece of information is that this is material I hope to present more often to foundations themselves. So feedback with that in mind would be also helpful. Feel free to turn on your mics and your cameras. Let us know if for any reason you can't.
And just to remind people, we are recording. If anybody doesn't want to chat on the recording, I can end it at any time.
Nice. I don't so much mind the recording, Janelle. It was awesome, and you've done a really great job of taking a ambiguous part of legal gray matter and just making it into an argument. And I was following it, and I was like, you know what? There's merit to this. There's definitely a way to put a good foot forward, and I'm inspired to see where development goes, because getting foundational grants or just 501c3s funding these works could be a super highway of funding, and if we could make it a norm. Wow.
Yeah. Thank you.
And Janelle, you did say that y'all are going to do a spotlight on the prudent investor rule, current interpretations.
Yeah, that's going to be an 1.5-hour webinar next week. It's going to be more wildly brainstorming about how we can, yeah.
Cool. Yeah, I just put that on the calendar. It's very relevant and work we're doing. So here we be.
Good. Nice.
Hi, Janelle. I have a question, if you have a sec.
Yeah, of course.
This is Brian Mikulanchek. So when you kind of talk about these themes with with private foundations, do you find that the reception kind of varies widely depending on if you're if you're talking to someone kind of coming more from the investment side, like the asset management side of the foundation, versus the program giving side, and have you kind of navigated that often wide difference you see between those sides of the foundation?
Yeah. Well, I have once, and I do think this is probably a trend. Yeah, program staff who make grants all the time are just like, hey, that endowment over there, could we use a little of that to support these awesome nonprofits? And the finance staff are, they're not as tuned into the program work, and they're thinking about, the numbers and what's prudent, and they often come from conventional financial management backgrounds. And so, I actually had a foundation program staff say, hey, can you come in and talk to our finance staff? And I gave a similar presentation to this. So I think there are foundations where they're trying to bridge that gap. And I think legal worries are one of the biggest things to overcome is if program staff say, hey, let's make more program related investments, and the finance staff say, that's not, I don't know if we can do that. Then if there's a lawyer saying, hey, actually you can, here are all the things you want to keep in mind, but you can, I think that's going to help foundations a lot. So yeah, to the extent that any of you advise foundations, helping them get this material would be amazing.
Yeah, thanks.
Thank you for the question.
And I just posted the link to next week's webinar in the chat if anybody wants to check that out.
Yeah, thank you.
I guess I got a theory question while you're here. And if we're looking at the IRS hasn't, decided a case or made a bright line, anything about a jeopardizing investment, right? Talking about coming from the prudent side over to charitable. Do you foresee, or would you imagine that a foundation might need to push this limit to actually create attention? Or do you think it's more of like a grassroots kind of just start advising clients and getting that motion moving that'll make that switch?
You're wondering if we kind of need to provoke some scrutiny so we know where the boundaries are?
Right, exactly.
I sometimes I think that would be nice. I want a foundation to just be a total badass and taking risks right and left. But on the other hand, it'd be nice. I don't know if actually this became a growing trend of foundations being a lot bolder with their investments before the IRS looks at it. The IRS does tend to look at prevailing circumstances and prevailing trends. So if it becomes a trend before they have to examine it, I think that's going to be better for all of us.
I see.
And I could be wrong about there not being any ruling about jeopardizing investments. It's just, somebody told me that, and I also couldn't find any. I kept looking at rulings, and I was like, they keep looking at every investment and being like, well, we can see why that's reasonable. You're good.
I gotcha. Well, I can do some looking too, but it's very interesting.
Yeah.
Yeah, I'm inclined to agree. I think that it would take, if you make it a trend, then it's easy to regulate behind. It can react to the trend. It's hard to advocate for a proactive law right now.
Yeah, right. Well, thanks for letting me do that with you all, and for the feedback. And I welcome any other feedback offline as well. And yeah, I look forward to seeing you all on more micro trainings. We just scheduled a whole bunch more. And if any of you all want to teach a micro training or even a nano training, in case you're intimidated by the 30-minute format, you could do a 15-minute workshop. And now with all these people sequestering themselves at home, I think a lot of people would be grateful for even a little bit of video interaction. So think about it. Let us know if you want to teach a workshop, and we'll schedule it.